So in this video, in 10 minutes, I'm going to teach you guys everything you guys need to know about imbalance. So right over here, we have a drawing, right? And we have a drawing of two different traders. We have a perspective of two different traders. We have 90% trader, and we also have the 10% traders, right? So obviously you guys know what this drawing is, which is a market structure, right? Over here, this is going to be the 90% traders, right? And the mistake that 90% traders do, which is retail traders, right? They trade the obvious, right? They trade zones where there's a lot of liquidity sitting and they become liquidity, right? And they also trade manipulation, which is exactly what we don't want to get caught into. And we basically wait for the manipulation to happen in order for us to be able to take a trade, right? So 90% traders are basically trading the markets wrong, and they do this every single time, right? So if you guys do this mistake, make sure to pay very close attention, because this is exactly what we're going to solve. On top of that, 90% traders, they all have a similar question, which is, hey, why does the market always stops me out before going into the direction that I originally planned to go to, right? And there's a lot of mistakes going on here, which is why price takes you guys out of stop loss and then price goes into directions, right? So like I said, 90% traders, they trade the obvious, right? So right over here, we have a proper market structure, right? Where the market creates, new highs, new lows, new higher highs, and new higher lows, right? This is a clear uptrend, right? Now, 90% trader, they trade what they're pretty much taught, right? If price session breaks above these highs here, price comes back, use it as a support, then price is going to continue pushing higher, right? That is very obvious, right? And what institution traders do, basically, they use these zones as an area where there's going to be a lot of liquidity, right? So when there's a lot of liquidity being, basically off the first impulse move, price doesn't originally or doesn't necessarily always going to come back to retest the high. The high is never going to tell you guys, hey, we broke above these highs. The market is going to continue pushing higher, right? That is just basically the market, just going along with the flow and with the trend. And here's the thing too that you guys need to understand, right? Because this is something that took me a while to understand. But once I understand it, this is how you guys reduce your trades and start focusing on high probability setups, right? The market does this every single time. Highs, lows, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? These new highs and lows, right, does not mean that you need to be in every single positions, right? This is just the market going into the directions, right? What you guys want to focus on is just trading on sessions that has higher volume, right? So if you guys focus on the New York session, stay with the New York session, right? Do not start trading maybe a noon New York session. Do not start trading early Asian session, late Asian session, late London session. You guys get the idea, right? Because again, the market is always going to do this, which is just a continuation, right? But we want to focus on setup, what happens on manipulation, and then we have the actual distribution building up, right? Which is following a proper system, right? So every time that I'm looking for a trade, it has to happen after a manipulation and then the distribution getting built up, right? So take a look right here. Like I was saying, this is just a very obvious zone. So what institution is going to do is simply take out the lows, which is going to be all over here. It's building up liquidity. Remember what I told you guys, the market does not necessarily come and retest highs to pretty much accept that the market is going to continue pushing higher. The market needs to do more than just retest highs, right? So whenever price goes in an uptrend, it has to come back and retest where the move originally first happened. So in this case here, let's say that this is the first high, this is the new low, and then we had an impulsive move. This impulsive move is going to be most likely the imbalance. So this is exactly going to be the zone, right? Another way to say imbalance is very similar to fair value gaps, right? Now, in imbalance right here is exactly when we have a strong push going along with a break of structure, which is going to be break above these highs, plus going along with the trend. Those are the three things that you guys need to understand, which makes a higher probability. So what you do here is that as soon as market break above, you do not enter off the first retest. Because remember, whenever price gives you guys pullbacks, the pullbacks, which is changing the trend from a higher highs, higher lows on lower time frames, the pullback is also building up bearish imbalances, which most likely price can either reject from it to then continue pushing lower. And that is exactly why it maybe can take you guys out of stop loss. And on top of that, we still need to clear out all of these lows here, which is sweep them out, right? Which is early buyers, early sellers as well, to come back and retest the premium zone. Once you retest the premium zone, you do not enter off the first one. Because remember, the market just dropped. So you do not enter off the first retest. The market is going to have a reaction from it, which is already key. Once price comes back a little deeper, sweep out these lows over here, we're going to start having a distribution towards the upside. So most likely here we have, right, from this exact distribution, and after price action swept out these lows, we're gonna have a bearish imbalance. And the bearish imbalance is exactly where we want a bullish price action to close above. And once price action closes above that exact bearish imbalance, that's exactly where we want to enter the market. And that's exactly how you guys are going to trade every single time. You're not going to trade from this. You're going to trade basically when price has a nice breakout above these highs here, right? And then price is going to retest. Once we close above it, you guys can enter the trade. And the same exact scenario goes along with the bearish side. The bearish, you're not going to retest the lows here, because check this out. You had to come back, retest the premium zone, where exactly where all the sellers stepped in. So all the seller volume stepped in right over here, not after this low. This low would not be broken if there was never sellers in the market and there was never volume. So price, yes, we came back, retest, rejected, sold off, but then this is not very high quality. This is a very low quality setups. And that's what 90% traders do. They trade very low quality setups because again, they're trading based on FOMO. They're feared of missing out this entire move here. And on top of that, they're also trading because they don't have a proper system and they're just trading based on what is obvious, right? So the market is just going to manipulate, sweep out these highs here, retest the actual premium zone. And then that's exactly where we want to enter, which is out of the inverse, not the full one, the inverse, which I'm going to show you guys obviously later on in this video. Now, what I was telling you guys about the 90% of the trader, which they trade the manipulation, which is also, liquidity zones. The market has two things, right? I'm pretty sure you guys have heard this one, right? Where the market kind of accumulates, which is ranging from highs to lows. And then the market has a fake move towards the downside or towards the upside, depending on wherever it goes, right? Now, keep this in mind. The market always needs to create a fake move in order to give you guys the real move, right? So this happens almost 80 to 90% of the time in the markets every single time. So in this case here, this is an accumulation. This is where the market is just accumulating highs and lows. There's nothing for you guys to trade here. Then the market breaks out underneath these lows. This is a manipulation. You do not take sells here out of the breakout, and you do not take sells after the retest. That's a no, right? This is what you guys are gonna do. When the market does this, right? It's not telling you, hey, the market is breaking underneath these lows, it's time to sell. No, this is most likely if price was coming from an uptrend. Let's say that there was an uptrend from this side here, from highs to lows. This is most likely price coming to retest some imbalance from the left side. And if you guys have pretty much asked me, hey, how do you guys catch your limit? How do you trade your limits? Based on imbalances. Imbalances, it's very, very simple, guys. And I'm going to show you guys also a trade that I took early this week. That was on Sunday. A trade based on an imbalance trade, which was a perfect wick to the highs. And I ended up closing out at 500 pips at a 3R. That was a beautiful trade, which I'm going to go over as well. But this is exactly what most likely is going to happen. If price is respecting this imbalance from the left side, which is going to be this one right here, most likely price is going to reject and it's going to close above it. It's going to wick it. And then remember, the left side, we're always going to have some bearish imbalances. So all you guys want to wait for is for price to inverse it. So once we respect it and we actually close above it, this is exactly where you guys want to enter your trade. Your stops are going to be underneath the lows and you target at least a minimum of 1 to 2 to 1 to 3 risk to reward. Right? Same story goes in the other side. If the market would have manipulated the highs, if the market would have manipulated all of these highs over here, most likely price is coming back to retest a bearish one. It's going to retest a bearish fair value gap. So what are you guys going to do here? You wait for market to calm down and inverse from this entire bullish move. You want to wait for price to inverse like this. And once we have bearish price action, which is after this entire manipulation, and price starts inversing it, which is closing underneath, then that's exactly where you want to sell the market. And your stops are going to be above the highs. You target a minimum of a 1 to 2 to 1 to 3 risk to reward. Because remember, the market, like I told you guys, is going to build a fake move because it needs to clear out liquidity. In order for the market to create a move, institution needs money. Institution needs big orders to step in. So in order to step in, they need to manipulate all the retail. This is where all the stop loss are being rested. So what is stop loss? Stop loss is money, right? So as soon as they hit their stop loss, they collect a lot of money from early buyers or early sellers, and then they enter the actual move, and then the actual move starts, pretty much distributing. So in this case here, once we break above these highs, this is called a buy stop liquidity. Price just simply grab liquidity, most likely from a bearish imbalance here. If price breaks underneath, that is called a sell side liquidity. Price grab sell side liquidity to retest the bullish imbalance, right? Remember, we don't really retest highs in order to, hey, the market is going higher. No, the market needs to do more. The market needs to retest a little bit more. Once you retest a little bit more, that's exactly where, the actual move starts going on. So that is something that you guys can definitely add into your trading, which is going to help you guys boost your, entries by 100%. Now, what I wanted to cover here was as well, all of these highs and all of these lows, like I told you guys, there's always going to be liquidity swinging from highs to lows. The early buyers, this is where retail traders are doing. Remember what I told you guys, that 90% traders, they do the same mistake, which is trading the obvious. If price breaks towards the upside, they are buying the market. So they're basically having buy stops order above here. If market is breaking underneath, then most likely they're having sell stops order here. And then these trades are very low quality because you're trading zones where there's a lot of liquidity pool. So don't trade like that, right? And on top of that, there can also be sellers that are, pretty much they're sellers here because we're respecting resistance, and then they get stopped out. So there's a lot of stop loss sitting above here. Now, let's go into the actual chart, and I'm gonna show you guys exactly what an imbalance looks like in candles, and then you guys can obviously do your work and go into your charts and start marking up imbalances and back tests so you guys can see that it actually works.